There's many different ways that people use to try and predict the stock market, and this is why you're doing it all wrong. What's up, you guys? It's Keith from Stock Hours here, back again with another educational video. Today we're going to be talking about predicting the stock market, and I'm going to give you one little hint right at the beginning of the video. The reason that you are not able to predict the stock market is because that is not how trading works. So I know the title throws you off a little bit, but hear me out. Trading is not a prediction or guessing game. It is all about reaction. So trading is 100% a reactionary job. Whenever the stock market does this, you do this. So that is how trading actually works. So the issue people find themselves in is they keep trying to predict where the stock is going or predict whether the stock is going to move up, down, sideways, whatever. You cannot predict the market like this. The way that we use to trade is all based on reaction. So what exactly do I mean by this? What I mean by trading is a reactionary job is you need to find your levels, and whenever the stock gets to your levels, you have to react to that. You are not guessing the stock is going from opening price to your level. You are waiting for the stock to get to your level in order for you to react. And there's other things that go into this as well that we will touch on in just a minute. So not only is trading a reactionary job, given the fact that you are not guessing where the stock is going to go, you are only reacting to what the stock is actually doing. There's a few parameters that we need to have in order to successfully make day trades or scalps. So a lot of the times you will see that even if a stock does get to our level and we don't react to it, that is for a specific reason. There's a whole bunch of puzzle pieces that go together to create one solid trade. So if one of those puzzle pieces is missing, we are either not going to take the trade or we are most likely going to stop out on the trade. This is why we save buying power, or whatever we're using, saving buying power, saving day trades, whatever, to be able to re-enter these trades when they do set up correctly. First of all, you're going to want to learn how to chart. So if you don't already know how to chart support and resistance levels, you need to look at another video we have on the channel, or you need to attend the free Wednesday night charting sessions that I do on this channel every single week. So now that that first step is done and now you know how to chart, we aren't just going to blindly take trades based off of these levels. There's a multitude of things that we need to see before we get to the point of actually executing our trade. One of them being momentum. Does the stock have momentum, or is it just grinding up to our level? If there's no momentum leading into our level, this means that we do not need to be taking a trade. This is when you see supports bounce and resistances reject. And I know a lot of people get that confused in their head. They're thinking, okay, why are we playing a resistance to the upside? The reason for that is because all of the puzzle pieces that we're looking for in the trade is setting us up for an upside trade. So we need to see momentum in our direction. We need to see good market sentiment. So this means we are either stronger than the market, we are following the market, and the market is also strong with the stock, or we need to see the stock doing its own thing. So there is three options there for us to be able to still consider taking this trade. We have momentum, we have good market sentiment. What else do we need to look for? We need to make sure that the volume on the stock is good and the volume on the overall contracts is high enough for us to execute. So first, we've got our levels charted. Second, we've got our strength and we've got our momentum going into our level. Third, now we have good contract volume. You want to make sure that these spreads are very, very tight, or as tight as they can possibly be, because if they are not, this gives you a huge risk of getting filled negative 5, 6, 7, 8, 9, 10% even, if you get a bad market fill. So now that we've got all of these things, we've got good volume, we've got good spreads, we've got strength, we've got momentum, all of these things are looking great so far. What else do we need to look at on the stock? Is it overextended? Is the move that it has made to get to our level already so far that we're bound to see a pullback within any moment? If so, then we need to highly debate whether we should take this trade or not. Generally, whenever I see a stock is overextended, I will wait for the stock to have a pullback before I will take the trade. Now, sometimes the level does break without me and I miss out on a trade, but I would much rather miss out on a low probability trade than get into a position to possibly make some money and have a really high risk of stopping out. I would much rather just miss the trade completely, because if you are in the mindset where you have to catch every single trade every single day, you are not going to make it very long in this business, because when you have that mindset, you're going to get stuck in a lot of bad trades. So if you don't have the patience to wait for a pullback, or you don't have the heart to be able to watch the stock break without you, then you may need to reconsider what job you want to do, because trading is probably not for you. But the majority of the time, when I see a stock is too extended leading into my level, I will wait for a bounce or a rejection from the level before I enter my trade. And like I said, the reasoning for this is because you do not want to enter in on a move that's already way overextended. So let's say opening price is $100. Our level is at $102. The first two candles of the day pushed us all the way to 102. Now that is a huge move on the stock with no pullback. I want to see the stock take some form of a breather, because otherwise I'm just trying to catch a falling knife, or in this scenario, it would be the opposite of a falling knife. So I don't know what you want to call that, but either way, you should understand what I'm saying. If the stock is too overextended going into the level, you are probably going to be one of the last people to buy, and you are probably going to be the one that gets stopped out almost immediately, because a lot of the times what we see with this is we might even break the level, but we'll wick by 5, 10, 15 cents and then reject. So I would much rather wait for these rejections. Anyways, we've got all of these things covered so far, and now we are figuring out, is the stock overextended, or is it at a reasonable area to be able to enter a trade? If so, we can move on to the next step. So now that we've got all of the things lined up for our entry, you want to look for trends and you want to look for other supports and other resistances so you can make your targets. So if there's another resistance or another support just past your resistance or your support, this is what you're going to want to use for some of your targets. So in order to have a good solid trade, you need to have a plan for exit. So if you are exiting the trade, you need to either know, am I taking this as a scalp, or do I have a target on this setup? This one is not that difficult to understand, but regardless, it is something I figured I'd throw in there. So now with all of these pieces together, you can see how trading is not a predicting job. It is 100% reactionary, because if any of the pieces of these puzzles are missing, you need to skip the trade. This is going to save you a ton of money and a ton of headaches over the course of the time that you're trading. Because everyone that I know that tries to predict the market and says, I'm entering right at the open because I know the stock is going to go up today, that is just not practical. It's also not very efficient, even if it does go in your favor. I would much rather spend 10, 15 seconds, or even 5, 10 minutes in a trade rather than hold for the entire day through all of the swing highs, the swing lows, all of the BS that you don't want to deal with when you're in a day trade, because you're going to pull your hair out by the end of the day. So these are the steps for creating a good trade plan and making sure you are executing on top of your game. Like I said, I know the title throws you off a little bit, but trading is not a predicting job. So the sooner you quit trying to predict the market and the sooner you try out all these steps, the sooner you will be profitable. So I hope this video helped you guys out. Do not try and predict the markets, because it's not going to work in your favor. You might as well go to the blackjack table. But anyways, I hope you guys enjoyed this video. I hope it helped you out. If so, make sure you drop a like, comment, and subscribe, and turn your notifications on so you don't miss my free live charting sessions that I do on this channel every Wednesday at 8 o'clock Eastern. I hope you guys have a great rest of your week, and we will see you on the next one. Peace.